So we did all these calculations in Excel. They as far as uh, the um, the payback period, we can see here that basically all we're doing with payback period is when do we get our money back? So with Project A, we received $200 in the first year, but then we and then so we're paid back in 1 year, but then we received the $800 in the second year, but then we have to pay out $800. So the payback period is either 1 year or 3 years. We don't really know. Um, so, but it works okay for Project B because we just take our $150 and subtract our cash flows from it each year, and whenever those cumulative cash flows equal zero, we that's our payback period. In this case, it's that payback reaches zero in 2 years, so it's completely paid back at that time. So if we were to do an NPV profile, you could easily do this in Excel. They set up your calculations and then just create a chart for where you did the NPVs, in this case, -10, 0, all the way up to 120%. This shows the two IRRs that are the result because of the two negatives in the Project A cash flow. The NPV for Project B is much more straightforward. I think if I recall, the IRR was 36% or something of that nature, which makes sense that the the, the dividing line would be right here. So, all right, so we can graph the NPV profiles. So this is Project A. Remember, we have our 0% or 100% IRR. Then Project B looks more normal. So the in this odd situation, if we were comparing the two projects, we'd accept B below this point, and then A above this point. So, but if you would not, let's set that backward. Yeah, no, B below that point and A above that point. So, but you wouldn't, obviously wouldn't accept at any point beyond that. But it's again, this is since we have the two multiples, that's a flawed analysis. So, so uh, pointed out the crossover rate. So, summary: discounted cash flow. We talked about net present value, the difference between the market value and the cost, and the except if NPV is positive, doesn't really have any serious problems. Actually, the preferred method. The internal rate of return, discount rate that makes the net present value zero. You take it if a project IRR is greater than the required rate of return. Same decision as NPV with conventional cash flows, not necessarily with unconventional. IRR is unreliable if we have unconventional cash flows or mutually exclusive projects. So we have to be aware of that. The profitability index. So it's a benefit to a cost ratio. Does utilize the time value of money. You take it if you take the project or invest in the project if the profitability index is greater than 1. They can't be used to rank mutually exclusive projects. So maybe use them to rank projects in the presence of capital rationing. So when you have shortages of money and so forth. Uh, so payback criteria. So payback period, the length of time it takes to recover the initial investment. Take if the project pays back with some specified uh, within some specified time period. The It does not account for the time value of money, and there's an arbitrary cutoff period. Discounted payback period, the length of the time until the investment is recovered on a discounted basis or present value those cash flows and then compare them to the initial cost. So take it if the project pays back in some specified time period. Typically, that's the useful life of the project. So as long as you get your money back before the project, the useful life of that project is over, then you would accept. The arbitrary cutoff period can be the case. The quick quiz. All right. Okay. So investment that costs $100,000 has a $25,000 the $25,000 uh, um, cash flow every 5 years. The required rate of return is 9%. The payback cutoff is 4 years. So, what's the payback period? The payback period in this case is fairly simple. It's just since this is an even cash flow, we can simply just take 100,000 and divide by 25,000. Well, that gives us a payback period of 4. The discounted payback period, hold on. Okay, so to calculate the discounted payback period, go up here. So we're going to use a cash flow function in our cash flow calculator. So CF0 is going to be negative 100,000. C01 is 25,000, and it occurs every year for 5 years. So F01 is 5. You click on NPV and you set I equal to 9, and then you go down to you can actually go down, you'll get down arrow and go down to DPB and hit compute, and you'll get an error because I think it says error 7 because the project never pays back. To calculate the NPV, we've already done so. So all we do is go back up to NPV and hit compute, and you should get, hold on. I got negative 2005, I'm sorry, $2,758.72. And then, so to do the IRR on your calculator, you just hit IRR compute. So I got 7.93%. So should we accept the project? Absolutely not. We've got a negative NPV. We've got an IRR that's below our required rate of return. And anytime you see this when you're calculating discounted payback period, that we're not going to accept that project either. So what method should be the primary decision rule? The NPV is preferable in almost all cases. The IRR can be unreliable, and especially in the case where we have irregular cash flows. So that's it for Chapter 5.